Is Monday, January 30th. This is the 12:30 p.m. section, and we are recording this for publication on YouTube. So as we get started today, is there a question?
Yeah, I'm just having trouble. It's not letting me create an account. It's like bringing me straight to the login name and password.
Okay, that screen still may not have a serial number, so you might need to use a different computer.
Like my laptop.
Like that desktop right there. So today we're going to do a few things. One, we're going to talk about creating accounts if you don't have one. Back to the question he was just asking. Two, we're going to go through lecture note 1, which is online, preparing for the first homework assignment, and I'll do a little example here at the end. So let's talk about your Bloomberg accounts. So again, on your desktops for your computers, IT did reinstall the majority of the serial numbers. I think they might have had challenges with a couple of these terminals. If you can't create an account on one, go to a different terminal, but they should almost all be working. But throughout the semester, if you do find terminals with problems, let me know. I'll flag them and report them to IT. So basically, you click on the Bloomberg icon on the desktop, let it load, and when it loads, it will come to a screen that looks something like this. And very important, you'll hit enter or go. And at the bottom, it should say create a new login. Okay? If it doesn't have a serial number, it won't show that. But if it does, you can create a new login. It takes about 3 minutes. So again, you can do this even here in class today. You'll get to share some terminals because again, we don't have enough people here. Creating it for yourself. You've probably not been a user before, so no, click next. Put in your name, choose a login. Again, it's not an email address. So mine is jperfetti. Put in your cell phone and any email. It doesn't have to be a UMD to email on this screen. When you hit next, it's going to ask where you want to get a confirmation code sent to. Probably pick your cell phone. They'll send you a text message. Put in that code. Once you do that, you'll be able to choose a password, and then you have an account. Right? So as long as you're creating an account in this lab, it's free and really simple and easy to do. Once you've created that account, you could use it on any Bloomberg terminal at the school, okay, including ones outside of this lab, right? But that's basically very important. You should all need to do that today because your homework 1, which will require this account, is due on Wednesday, okay? So while you're creating some accounts, once you log in and create your accounts, you go back to the login screen. You will log in with that newly created username and the password that you chose. Now, I have a step that you will not have, where it's going to ask me for this QR code, but you won't have that. I have to do 2-factor authentication on my laptop, so I can use it outside of the lab, but you won't be able to use it outside the lab, so you won't have to worry about a QR code. All right, once it loads the software, and again, it's actually loading 4 screens. So if you have a multi-screen monitor, you can put different screens on different parts of your monitor, but it'll bring you to essentially a screen with a command line, right? And again, this command line is going to be very important. Now, as I mentioned, there's 34,000 different functions you can type into that command line. It's also got some Google-like functionality. So for example, if I wanted to type in what is the price of oil, then Bloomberg will show me what functions and securities meet that. So for example, if I go here, I can look at the price of West Texas crude today, which is $78.82 a barrel. All right. One of the other cool features of Bloomberg is over here, GP, which is basically graphing function, graph the price. That would be the price of oil for the last 12 months. If I wanted to look at a 5-year view, I could click here and show the price of oil, for example, over the last 5 years. Okay? Same thing with companies. Like if I replace this with Intel, for example, this is Intel, and I did graph price. Here's the last 30 days of their share price. Can you tell me when in the last 30 days you think they reported their earnings? Do you think it was a good or bad earnings release? Pretty brutal. Okay. Matter of fact, you can click on key events and it will pop and overlay key events that have occurred on top of this. You can hover key events and read the news stories relaying their earnings release bad news. Matter of fact, if I want to switch this to a 5-year view, those would be the key events over the last 5 years. Load just a second. The other thing is where it says add data here. If I want to put other data on this chart, I could do another overlay. So for example, where it says add data, if I typed in ROIC as a field, that would overlay that blue line over the stock price chart on ROIC by Intel over the last 5 years. So you can see that their share price seems to be fairly correlated to their ROIC performance. Okay? And again, all the key events, which I could hover over to see what might be triggering stock prices up or down during that period. So again, very powerful tool. That's GP, graph price. Right? Another feature you might use pretty heavily in Bloomberg is something called Daybreak, D-A-Y-B. Every morning, traders generally gather around to talk about what they're going to be key information events trading on during the day. And so this is kind of like a trader talk newsletter. So first, what do you need to know that's going to be key for the day as a headline? And you can see these are key things that are being talked about today. There's basically an Indian company being accused of massive fraud. They're saying they didn't do it, but Wall Street's very interested here. They've been heavily shorted as a stock. What's going on with stocks in the week, etc. If you click on coming today, these are basically economic items that are going to be released throughout the day, at what time they're going to be released. So if you need to know about that, might move the market. Trader talk, again, just kind of key things that they think might be of interest to try stocks. Key opinions on business stories. Summary of the front pages of major news articles around the world, specifically business, what's going on in the U.S., what key company news you might want to follow, ESG, just because it's gotten popular. And you can also add in your own tickers to track your own news stories on those companies on a daily basis. So again, just a quick place to get to the news summary of what's going to be important for the day. If you want to see the news wires, just go to top, T-O-P. This basically aggregates in real time all the news wires. Right? So if you're a trader, you got 4 screens on your monitor, this will typically be one of the screens. All right, so as news is hitting, it'll hit here first before it pretty much makes any news network. Okay, so this is just real-time access to all the news feeds. You don't need any subscriptions; you get it all here. All right. So, and again, they use an algorithm to do the highlights. But obviously, if you want to look at the top stories and the history of these, you click on more, and there's a lot of stuff going on. Okay. All right. Go back. My screen is caught in an endless loop here. Stop. All right, sorry, breaking out of their endless loop here. Let's go back to a company. Let's look at Intel. So a couple other screens that we will use pretty heavily. Another one we're going to use is something called FA, which stands for Financial Analysis. You can also click on that. These are the historical numbers for a company, publicly reported. Okay? So down here are a series of tabs, historical income statements, balance sheets, cash flows, ratios, segment reports, etc. from the 10Ks, 10Qs. So if you click on income statements, it gives you several different ones. As reported, as a sub-tab, would give you literally what came right out of the company's annual report or 10K. If you click on BBG adjusted, what Bloomberg does is the analyst will adjust a company statement to take out one-time items or non-recurring charges to get a more normalized view. Bloomberg does that adjustments for the analysts. And the BBG adjusted is typically the statements that the analysts are focused on as opposed to the as reported, which come from the accountants. Okay? But nonetheless, let's say that you're going through the adjusted statements and you see Intel had this non-operating loss of $482 million last year. If you click on any number, Bloomberg will give you transparency about how they calculate this number, and more importantly, if you click on this little icon, document transparency, it will bring you to the statement that was filed and where in that filing they got the data. Okay? So for example, if I'm looking at this number here, there it is, 597 million of interest expense. Where'd they get that? I click on it, it opens up that 10K from 2021, and then it will basically go to the point in the document where they actually got that interest expense number. Okay, so again, another nice feature about Bloomberg, which is how they make sure things foot, they actually bring you to the document sources or the data sources where they got the information. That's FA. Another screen we're going to use is WACC, which stands for Weighted Average Cost of Capital. This will calculate a real-time WACC as of this morning. For Intel, it's 7.8%. They're 72% equity. They're 27.8% debt. Cost of debt is 4.3% after tax. Cost of equity is 9.1. If you click on the 9.1, it'll bring you to the CAPM model that was used to estimate the cost of equity. That is the yield on the 10-year Treasury right now. That's the equity risk premium, and that's the market beta that they're using for Intel. They use a 2-year beta by default. Any one of these numbers you can overwrite. So if I want to use a different beta or a different market risk premium, I could type it in. It would recalculate the WACC for me automatically. If you're on a screen, you don't know anything about it, help. Explain what's going on with the screen. This is also part of the certification. I told you there was this extra module that talked about terminal basics. This is the reason to do terminal basics. It will show you some things that you had no idea were here. Okay. Another screen that we're going to use a lot this semester is called ANR. ANR, or the Analyst Reports, the Analyst Recommendations. So this is a summary of what the sell-side analysts are saying about Intel. I mentioned that Intel had a horrible call and a horrible earnings release last week, and the analysts were pretty unhappy. Well, you can actually see what the analysts are saying. So these are the analysts of them that are covering Intel. They're down here. Make my screen a little smaller. There we go. These are the analysts, and you can see the dates, the 27th and the 30th, that they were updating their reports. And I scroll down, I can read all of what the analysts are saying about Intel, essentially. So these are called the sell-side analysts. And so that's the point. Wall Street spends $4 billion per year on sell-side research, right? So let's say you work on what's called the buy side. I'm a fund like BlackRock that's investing in a bunch of companies, and I'm an active fund. So what I do, because I got 100 companies in my portfolio in all these different industries, I can't keep track of all of them and their competitors on a daily basis. So I hire specialists. The specialists are the sell-siders that work for the bank. These are experts in different vertical segments. I pay them to tell me what to do. So these buy, sell, hold reports that the analysts write are not for the general public. They're for the buy side. They're for the institutions. So I hire, just as an example, Ross Seymour of Deutsche Bank to tell me what to do on Intel. Okay? And right now, as of January 27th, his team says hold the stock, which means I'm going to leave my portfolio alone. If somebody said sell, like DZ Bank, Ingo Werman, and I was paying him, then I'd probably trim some of my portfolio of Intel stock. So again, the buy, sell, holds are driving what the actual owners of the stock, which are paying them to tell them what to do, actually do. Now, Bloomberg translates these into rankings. So again, if you're rated a buy, buys are worth 5 points. 9 of those people below, scroll the list, say buy. 26 of them say hold. Holds are worth 3 points. 11 of them say get out, sell. That's 1 point. On a 5-point scale, Intel to investors is a 2.96 out of 5 and falling over the last 30 days. Right? The other thing the analysts do is they come up with a stock price target for the next year. Where do I think Intel shares are going to be trading at in 12 months? Bloomberg then takes a wisdom of the crowd approach and averages all the guesses. The average Wall Street guess for Intel's stock price in 12 months is $29.55. Today, they're at 28, which means there's not much upside, 5.5% upside in Intel's stock price over the next 12 months. So not only were the analysts unhappy with what they heard, they're not liking a lot about what they're seeing in Intel's future. And basically, Intel's having a problem because nobody's buying PCs. The only PCs that people seem to be buying are Apple's. Nobody's buying the rest of the market's PCs. And Intel makes those chips, which means nobody's buying their chips. And there's a huge buildup in inventory, so they're not even selling their new chips because they can't get rid of the inventory of the old chips. And that's caused a real sales problem for Intel. And by the way, these analysts are also saying probably the industry as well. So other chip semiconductor makers, particularly on the PC side, got hammered as well because of Intel's earnings report. But that being said, if I want to see what Deutsche Bank did, I can click on Ross. And this is his coverage universe. Now, his team, which will be Ross at Deutsche Bank, an MBA in finance, and an undergrad in finance. It's usually a 3-person team on Wall Street. Okay? And their life is covering those 18 semiconductor stocks. That's all they write research on. Right? Now, typically a sell-side team picks which companies it wants to write research on. And most companies choose between 10 to 15 stocks to cover. So 18 stocks is actually a lot of stocks that they're covering and writing research on. Okay? So those are the opinions on the other companies they're covering. If I want to click on biography, this is Ross at Deutsche Bank. That's his email address. That's his phone number. That's Bloomberg email. He works in San Francisco, and that green dot means he's logged in right now to Bloomberg, and we can IM him. Okay. Now, since this is a system of record, when Bloomberg users IM other users, they usually respond, at least the first time, before they'll block you. Right? But nonetheless, if you're trying to get a job and you're willing to do a little cold calling, you have access to everyone on Wall Street. Okay? As a matter of fact, not only through here, another very powerful feature of Bloomberg is called Piop. Every registered user in Bloomberg, even you, when you just create an account, will be in this database, and it's searchable. So I can say, show me every employee that works at JP Morgan that's using Bloomberg. I can also say, show me every person at JP Morgan that's a graduate of the University of Maryland that works at JP Morgan. Okay? And I can do those filtered searches, and I will get their real-time contact information. All right? So if you want to be aggressive and you're trying to get to a place, this is a Rolodex of who works where and how to get to them. Okay? So don't abuse it, but nonetheless, if you're trying to get a job, no stone should be left unturned. All right, back to Intel. Another screen, if I go back to ANR, is what these analysts are doing. And again, I'll focus on Deutsche Bank. Is if you see that little Excel model that's locked, they are doing what we're going to learn how to do this semester. They're forecasting the cash flows of Intel into the future. And they're doing it in spreadsheets because basically that's what Intel's share price is based on, the expected future cash flows. So these are the expected future cash flows of the professionals. So they upload these spreadsheets to Bloomberg for sale. Okay? So if I click on Ross at Deutsche Bank, if I click on research, this is his team's research on all of those companies. Now, for some research, we actually get access to. Deutsche Bank, JP Morgan will actually see the research reports. So if you want to read the research reports, you can see the research reports. Others, like you go to Goldman Sachs or a few other firms, and you click on research, it's going to be blank. Okay? And the reason why is because they sell the research, right? And that you have to pay to get access to the research. They'll give you their Excel models because you have to pay to get access to their Excel models. In fact, the Excel models can be accessed at a screen called MODL. This is where the analysts will upload their Excel files to Bloomberg. They'll be over there on the right. Again, they will be locked. So if you try and download it, it won't let you, okay, unless your account pays them to let them give you access to the spreadsheet model. But nonetheless, one of the things Bloomberg does do is it is trying to structure consistent analysts of companies analysis across all of the companies that are being covered by the analysts. So that way we're actually forecasting the same things. So this is what Bloomberg is starting to do. It's starting to pull key numbers out that everybody's forecasting, and it shows you to them. So for example, it doesn't just forecast sales, it forecasts data center sales versus client computing sales, network sales, mobile, etc. It's got headcount, other things, and it's all by company, but key operating drivers as well as financial drivers for these companies. Now, this is the forecast for 2022. I could switch to any year that I want to see a forecast for, or if I click on multiple periods, this summarizes the average of all those spreadsheets in terms of the forecast over time. So how is Intel expected to do for the next 4 years compared to the last 2? That's on the screen. All right. Now, where we will actually use this is Bloomberg then summarizes this screen on another called EEO. It's probably the most important screen you're going to use this semester. Earnings Estimate Overview. This is the wisdom of the crowd. This is the average forecast of those professionals of Intel summarized through 2026. Okay? Revenue, profit, cash flow. The way this screen is created is for 2023, revenue for Intel is expected to be $52 billion. Last year was $63 billion. Okay? That's a lot lower. That was the unexpected drop that shocked the analysts last week when Intel said that we're going to shrink by 15 to 20% next year in 2023, right? Because nobody wants our chips right now, right? Which is another problem because Intel's spending $30 to $40 billion to build a new foundry in Ohio as part of the big Biden CHIPS Act, okay? And so somebody's eventually going to buy those chips, and Intel right now is having trouble finding customers. So, but that's the point. Where does this $52 billion come from? These are the averages. You can see this pop-up box of all the guesses. So 44 analysts uploaded guesses for revenue for 2023. Okay? 5 of them were thrown out as mathematical outliers. The remaining 39 were left in the average of the guesses to create the consensus. The low guess was 46 billion. The high guess was 65.7 billion. It's a big range in the guesses. But the average guess was 52.386, right? And that change has gone down 14%, and $8.5 billion is the average guess in the last week, and that came out of the earnings call, which was really dismal. Okay, and that's what shocked Wall Street last week when Intel said, your guesses are way too optimistic for what we're going to do next year, right? But nonetheless, these sales, profits, and eventually cash flow basically turn into that share price. Right? Because that's what we know. Company's worth the sum of its future cash flows. These are the guesses of the professionals about what the cash flows are going to be. Okay? So if I know the guesses and I know a discount rate, I can come up with a share price. Right? So this is the baseline. Now we can be above or below the baseline, but this is the baseline of the professional crew. You have access to this. And so back to the annual earnings release, look at this. For 2022, and I'll go back one period by clicking on this back arrow. This is December 22's estimates. This is what they did. Okay, so in terms of 2022, you'll see that Intel came in pretty much in line with most of the numbers based on the guesses versus what they reported in the earnings call. Okay, so the problem was not 2022. The problem with Intel is 2023. Okay, because basically they told the analysts, which these numbers were expected to grow, all of a sudden that they're not going to grow, they're going to shrink 15%. And that was a big surprise to Wall Street last week. It freaked everybody out about Intel, freaked everybody out about a bunch of PC makers and a bunch of other semiconductor makers because that was unexpected softness after 2 years of huge demands. Okay? So nonetheless, stock price about the future, this is where you can start to see a lot about the future of the companies. EEO, Earnings Estimate Overview. Questions about this? All right. And by the way, when I say buy side, the institutions that they're selling their research to, for Intel, this is the buy side. HDS stands for holders. And so basically, these are the institutional shareholders of Intel on a scrollable list from largest to smallest. So right here, 63.59% of Intel shareholders are in that scrollable list. Their largest shareholder being Vanguard, which owns 361.6 million shares, or 8.74% of the company. Okay? Their smallest shareholder, down here, which owns like a couple of shares. Right? And what I'm telling you is when this company down here, which owns Intel, heard that earnings call and says, I'm going to sell my 5 shares of Intel. So when Spartan Planning and Wealth Management LLC sells their 5 shares of Intel stock, nobody cares. Right? It will not affect Intel stock price. It won't even be noticed. It's not even a rounding error. Okay? But when going to the top of this list, Vanguard buys 17 million shares, or BlackRock sells 9 million shares, or Capital Group sells 32 million shares, that sets the stock price. So the point is, these people set the stock price of companies. Right? As a matter of fact, think about this. This is 9% of Intel stock is this one company. 9, 17, 21, 23, 25. The top 10 companies represent 30% of all of Intel's stock. These people are the most important to keep happy, okay? Because when they do buy and sell, they buy in giant blocks, and it's noticed when they move. So these are the price setters. And what I'm telling you is if you're BlackRock or Vanguard or State Street or one of these big firms, because you have so many companies in your portfolio, you need help keeping track of them. That's where the sell side comes in, okay? Because you pay them for the research to tell you what to do. And if they don't do good, you fire them, you get somebody else. All right, so just a little bit about how the sausage is made. Questions, comments about any of this? All right, so back to your assignment, RV. Let's do Wednesday, 10 a.m. We moved it from today to Wednesday because of the Bloomberg issues. Custom. Make sure in your settings, global settings, you got rid of that middle bar. You can keep it there if you want, but I think it's kind of useless. Uncheck show top section. Make sure you check market cap weighted average. The market cap weighted average is what we're going to start calling the industry average this semester. Okay. So again, you had your template that you created last week, or I created in class, you got to create, which is ROIC as of the latest filing against the WACC. The top line is the industry average. And so for homework 2, you have to find an industry with a negative spread, an industry where the ROIC as the latest filing is less than the WACC. That is not this industry. Okay? So it's not the company, it's the industry. Okay? Once you find that, and I think we showed a couple in class last week, then you go over here, top right corner. This is the export box. Export, take a screenshot, save the screenshot. Okay? Put the screenshot, which will give you a file. You upload that to Elms. That's homework 1. Homework 1 does not have a write-up. Right? So basically Wednesday, 10 a.m. Should be pretty easy. Questions about homework 1? What you need to do, how you need to do it. Again, industry with a negative spread. If you can't think of one, go back and watch the video. Or one other thing you'll learn about EQS, the equity screening tool. In the equity screening tool, there are 1.6 million securities in the database. Here, you can search and filter out any of them based on any criteria you come up with. So for example, let's say I want to take out of the 1.6 million stocks in the database, I just want to look at the S&P 500. Okay, so add criteria, SPX is the short code for the S&P 500 index. Click on that, and basically All the securities are filtered down to 503. Now you might say to yourself, gee, I thought there were 500 companies in the S&P 500 index. There are, but 3 of them are dual listed stocks. So for example, Google has a Class A share and a Class C share. So Google's actually in the index twice, even though it's one company. Facebook also has dual class shares. I forgot who the third company is. But nonetheless, these are the 500 companies, 503 shares representing them. And then I can add another criteria. ROIC less than 5%. So these would be the 114 companies in the S&P 500 index that had an ROIC less than 5% last year. So if you can't think about who might not be doing well, you can quickly filter out who's not doing well. Okay? And if you scroll down, see results, it'll list the companies. And if I want to screen further, I can do that as well. Okay? Matter of fact, one of your assignments coming up is going to go the other way. Because again, you're going to have a Bloomberg trading challenge where you got to figure out who you want to put money into that's going to do well over the next 6 weeks. Well, what I could do is I could change this criteria from ROIC less than 5 to ROIC greater than 25. So who did really well last year? Well, in the S&P 500, there were 65 companies that had an ROIC above 25%. How many of them, add another criteria here, revenue growth rate, was greater than 25% as well. So there are any 25 companies. 25% growth, 25% ROIC. There are 44 companies that matched that list last year. Okay? So basically, if I want to know who they are, click on the criteria, but that might give me a starting point of companies that last year or at least doing pretty well. Maybe I want to look at those about potentially doing well this year, etc. So lots of ways to do it. Matter of fact, if you saw on the screening criteria, one said like product segment revenue, another said geographic revenue. So for example, if you're worried about the coming trade war between China and the US, and you want to know which US companies in the S&P 500 index have a big exposure to China, you could say, show me companies with China revenue greater than 20%. Okay? Companies like Apple might pop up on that list. So again, lots of different ways to slice and dice, equity screening tool. Okay? But what you need to do for Wednesday, RV, spread, find a negative spread. All right, let's talk about lecture note 1. So at this point, you should have bought the textbook, started the readings, and one of the things that the book is about is what McKinsey calls the 4 cornerstones of value creation. And the idea is this. McKinsey's in 1,000 boardrooms, works with a bunch of senior leaders. What they do is they basically take the academic finance content and make it practical to the real world. And these are the 4 things that are very important to valuation. So what are they? What are they telling the world's who's who that you got to focus on? Number 1, it's all about spread. Okay? ROIC minus WACC. Right? Because that's NPV. Right? ROIC is a proxy for IRR. WACC is a proxy for your R. The only way you create value over time is if your IRR is greater than your R. Right? And so that's the whole point. Our ROIC is just a 1-period IRR. Right? And most importantly, it's a proxy for free cash flow. ROIC is a proxy for free cash flow. So a company that makes a 20% ROIC generates 20 cents per dollar of investment. A company that makes a 5% ROIC generates 5 cents per dollar of investment. And I'm telling you, a company that generates 20 cents per dollar, all things being equal, is going to be worth more than a company that makes 5 cents per dollar. It's just simplifying the free cash flow, right? And then the WACC is the expected ROIC, right? So unless you exceed that expectation over time, you cannot create value. Now, 2 things come out of this. Point number 1, we talked about this last Wednesday. Half of your performance of that spread is the industry. If you're in a good industry, it's easier to make money. If you're in a bad industry, it's harder to make money. Okay? So half your performance is going to be based on that market. That's what we're going to start moving into next week with EIC. So how do we understand the market and how it impacts a company? Okay. Now, second thing that comes out of that equation, spread, is that growth does not create value. And you got to get that out of your head. Growth does not create value. There's good growth and there's bad growth, right? And I'll give you an example. Let's go back to Intel. Oh no, not again. All right. Let's go back to Intel and let's look at the spread of this industry. Custom spread. And then when the data loads, let's look at this company called Marvell Technology. All right. If Marvell Technology, which is the company on row 108, is borrowing at a WACC of 10.95%, and they're taking that money with a 10.95% expectation per year, and they're investing and they lose 1 penny per dollar, the negative 1 cent loss cannot pay back that cost of capital, right? They're destroying value. But if they do more of that, they keep borrowing at almost 11 to lose a dollar or lose 1 cent, 1% every time they borrow at 11 and do more of that, they're just going to dig themselves deeper into a hole. Right? If Qualcomm can keep borrowing, which is at row 102, at 9.68, investing and making almost 44% per year, well, I want to do that all day long. Growth is the accelerant to value, and that's the point. There's good growth and there's bad growth. And we got to suss out the difference between the two, right? And again, it sounds simple, but in the real world, it gets very difficult. So between February 2021 and August 2022, while teaching this class, I also became the CFO for a $400 million subsidiary of Blue Shield of California, a $21 billion company out of San Francisco. And I ran their Bay Area network as their chief financial officer. It's a $400 million subsidiary. We had about 2,900 physicians in our network that we were managing for the San Francisco Bay Area, $100 million operating budget. It was an interesting experience, but I'll tell you, in the state of California, in the healthcare market, HMO is in structural decline. People are not signing up for HMO nearly as much. They don't like it. And increasingly what they're signing up for is what's called PPO healthcare plans. The difference is if you get an HMO, you get a primary care physician who's a gatekeeper to block you as much as they can from using any additional services. Okay? And you got to get their permission to go see specialists. If you have a PPO plan, you can go to any specialist in the network. You don't need any pre-approval. You just show up and all the claim gets paid. So PPOs are much more popular than HMOs for patients. Okay? But here's the problem. As we were signing up physicians and networks for PPOs, we were paying them 100% of whatever the claims that they submitted, which basically meant we were a pass-through. Okay? So whatever your medical cost was at that visit, we paid it out at 100% as the middleman. Well, when you have no margin on those claims, you don't make any money on those claims. And it's really easy to sell business that you're basically giving away for free. But I'll also tell you that the cost of processing a claim is not zero. So we were spending money to process claims that we made zero margin on. And we were signing up people left and right. And we were paying people bonuses and celebrating them for all of this growth. And as chief financial officer, I was horrified. Because the more we grew, the more money we lost. And I was like, why are we even bothering to do this? I'm like, we're not a charity. Like, we got to make money doing this. We can't just give it away for free. And that's the point. Like, in the real world, people are like, oh, if we're growing, we're going to make money. No. Sometimes you grow and you lose money. And the same is true at the corporate level. So that's the point. We have to understand which companies are going to grow and make money and which companies are going to grow and are not. And not all growth is good. And we have to get away from the growth bias. So I'm not saying we don't want to grow, but we got to separate good growth, value creating growth from value destructive growth. And that's the point. It's the growth return, growth spread combination that drives value. That's the first cornerstone. Second cornerstone. It's about cash flow, not income. Income that the accountants give is a piece of paper, all right? It will eventually represent the cash flow, but it's not the cash flow because of timing differences. And so in finance, valuation shows that it's mathematically much more correlated to cash versus income. So there's two problems with income. Number one is that timing difference, meaning you're going to get a pay stub if you're working usually at the beginning of a month. So a lot of people are getting paid today or tomorrow, okay? But how much money do you have on the 15th of the month, right? It's not what you got put in your account today. It's how much do you have in 2 weeks. And if you run out of cash in 2 weeks, bad things are going to happen. So it's not about the income, it's about the cash flow because timing really does matter. And there's something called time value of money. When you get the cash changes the value of that cash. So even though income and cash flow will eventually be the same, those timing differences are very important when it comes to valuation. And so cash flows are much more based on, values are much more based on cash flows, not income. So a lot of what we're going to be doing this semester is, ironically, accountants take all their time taking cash and turning it into these accrual statements. We're going to take time to take those accrual statements and turn them back into cash. Right? And unfortunately, it sucks as a process, but we have to do that to really understand values of companies. Cornerstone number 3, it's about the future, not the past. I don't care what Intel did in 2022, just like the analysts didn't. I care what Intel's going to do in 2023. Right? I don't get the cash from last year. At this point, I get the cash from next year. So the future is much more important to value than the past. Right? As a matter of fact, when we think about intrinsic value came from in the 1970s when the University of Chicago basically did a big data set where they looked at lots of different assets over time. And they found that whatever cash these assets generated over time became their price in the real world. And that's the concept of cash equals price. Whatever cash you generate eventually becomes your price. That's intrinsic value, right? But the problem is, how much cash is Intel going to generate into the future, as I'm guessing today, right? Those guesses that I showed you on the EEO screen are just that. They're guesses, right? So what Warren Buffett says is, look, in the short run, the stock market is a voting machine. In the long run, it's a weighing machine. Today, I guess what I think the cash flows are going to be, price based on that. In the future, I adjust to the actual data of what comes out, okay? But here's the problem. We never get to the future. The first 10 years is probably the most important valuation forecast horizon for any company. And if I asked all of us to figure out what Intel's going to do for the next 10 years, no one really knows with uncertainty. We're predicting the future, right? But we're all going to make guesses. And like I said, you can see what the analysts are guessing for Intel's future right now. And they're going to be wrong. They know it. But they're giving their best guess based on the data today and the valuations based on that forecast today. Now, in 10 years, they're going to find out if they were right. But what I'm telling you is, even if we went into a time machine 10 years from today, the last 10 years aren't going to matter anymore. It's the next 10 years. So here's an always in finance. Price is always expectation. That's the point. That's why valuation is as much an art as it is in the science, because it's how do you come up with the expectations. The math is actually not that hard. It's algebra, right? The hard part is figuring out what to put into the formulas, right? And when you're dealing with the future, you're dealing with a lot of uncertainty, right? But nonetheless, that's what we're going to focus on this semester, but future more important than the past. And so that's why we're going to be using Bloomberg, because there are very few tools out there in the world that give you insight into the thinking of the professionals of what they think the future is going to bring. And it doesn't matter whether they're right or wrong, right? Here's the point. If you're losing money and I expect you to make money in the future, I'll invest in you, whether you do or not. If you're making money and I think you have no future, I won't invest in you. Doesn't matter what you did in the past. So the expectation becomes the basis for valuation. Cornerstone number 4, competitive advantage. Darwin is at work in the marketplace constantly. And there's 2 charts in the readings for the book that you should burn into the back of your brain. One shows what happens when McKinsey looked at buying and holding stocks over time from an ROIC perspective, and the other shows what happened when they bought and held stocks from a growth perspective. In every case, there was regression to the mean. The top growing companies don't stay on that list for very long. The top ROIC companies today don't stay on the list long term for very long. And what I'm telling you is that's natural. Nobody that's doing well today does well forever, right? Go back 10 years. We were talking about Microsoft and Intel's duopoly and who would challenge them. 20 years ago, the PC company was Dell. They were the dominant PC company. Apple was on the verge of bankruptcy. They were an afterthought. 30 years ago, it was IBM. They were the dominant player in technology. And I'm telling you, in 10 years, I don't even know who it's going to be. Probably OpenAI, ChatGPT. But the point is, it's going to evolve. And so the question is, not do you have an advantage, it's how long do you have an advantage? And it's not that are you in a good market, it's how long is this market going to stay good before it changes. That's what we have to figure out as analysts. That's the whole point of EIC, right? Is that there is a time that you maintain your advantage. And it's not infinite. So what is that time? Now, some companies can have longer runways than others, but that's what we're going to have to start to figure out. So these become what McKinsey calls the 4 cornerstones of value creation. Behind this is the math. The math is called key value drivers, KVD. And this is the math behind the cornerstones. Summarized at a high level, 3 things matter: spread, growth, sustainability. How long the spread lasts, how long the growth lasts. ROIC is a function of margin, how much you make, times productivity, how often you make it. So 5 things matter to valuation: margin, productivity or efficiency, cost of capital, which is risk, growth, and sustainability, how long things last. Mathematically, those are the 5 most important things that drive valuation. Those will become the key value drivers of our valuation models. In this class, again, following Warren Buffett's rules, we are going to define an attractive industry by spread. So to have an attractive industry, your ROIC as an industry must be greater than your industry WACC. That's the opposite for your homework. A value-destroying industry has an ROIC less than its WACC. That's what you got to find in your homework assignment. We are going to define in this class competitive advantage as outperformance. If you are doing better than your peers, the only way you're going to do better than your peers is to demonstrate that you're doing better than your peers. Have a higher spread than your industry. That's competitive advantage. If you have an ROIC minus WACC spread below the industry, you're not demonstrating competitive advantage. So again, these will be 2 important definitions that we're going to use this semester. Another definition we're going to use this semester is essentially how we get to the key value drivers. So we're going to start out to define a few things, key terms, by looking at this hypothetical company. So we have this company made up, company A we'll call it, that makes $100 million a year in no pat or no plat. No plat is the McKinsey term, no pat is the generic term. It's basically your operating profit after tax. And the key is it assumes you're a debt-free firm. Because here's the idea. We don't want to mix operating and financial performance. Because you can take 2 firms that have the exact same operations. One has debt, the other doesn't. The one that doesn't is going to look better. Doesn't mean they're a better firm. It just means a different financing choice was made. So we're going to strip out the financing choices and just look at the operating performance of the firm. That's no pat or no plat. It's the operating profit and then taxes as if you're a debt-free firm. Okay? Now, let's assume that's $100 million. 2 choices of what you can do with that profit. We tend to overcomplicate this, but seriously, there's only two things you can do with your profit. You can either reinvest in the business to sustain and grow, or you can pay it out to your investors. That's it. Now, you might say, well, gee, there's like all these different things I could reinvest in. I could reinvest in working capital. I can reinvest in plant. I can reinvest in R&D. Can reinvest in yada, yada. Just reinvestment. Lots of different ways to pay out. I can buy back stock. I can pay a dividend. I can pay off debt. I can make an interest payment. I can pay a preferred shareholder. Payout. Okay? So we're just simplifying. Reinvest or you pay out. So that creates two very important ratios this semester, the reinvestment rate and the payout rate. The reinvestment rate is the percentage of the profits that are put back into the firm. The payout rate is the percentage of the profits that are given back to the investors. In this case, $50 million to each, therefore a 50% reinvestment rate and a 50% payout rate. These two ratios have to add up to 100% of your profits. Therefore, 1 minus the reinvestment rate is the payout rate. 1 minus the payout rate is the reinvestment rate. Everybody following? Okay, so we have this hypothetical company, 50% reinvested, 50% paid out. Let's assume, for simplicity, a 10% return on investment. They made 10% ROI historically. They're going to make 10% into the future, just to keep the math simple. So, if I reinvest $50 million at 10%, I'm going to have $5 million of new profits. If I have an underlying 10% ROI that doesn't change, my $100 million is not going to change. So last year I had $100 million in profit. Next year I'll have $100 million plus the 5 of the new profits. I'll have $105 million. I will grow at 5%. It's just kind of working out the math. This is the important shortcut. The forecast for growth, G, also known as sustainable growth. The formula is take the reinvestment rate and multiply by the ROIC. So, 10 reinvestment rate times the return on the new investment equals the G. So 50% reinvestment, I make 10% on the 50%, I can sustainably grow at 5% a year. What sustainable growth means is it's not the actual growth rate per se, it's the rate at which I can grow with internal funds. Anything above 5% would require external financing. Okay? So that's the point. Two things drive ability to grow. What's your reinvestment and what kind of return do you make? Companies with high levels of return, ironically, can grow pretty fast. And because they're making high levels of return, generally don't need to borrow money. That's the point. People like Google and Apple don't need to borrow money because they're making so much money that they can self-fund their growth. It's the companies that actually have terrible returns on investment that struggle with the growth because their ROI is so low, they actually can't sustain the growth that they're trying to do, and they need to go borrow money. And remember, the rule in banking is to lend money to people who don't need it. Right? If you're struggling and you want a bunch of money, all right, why would I want to give it to you? Right? I don't want to invest in failures. I want to invest in successes. So when companies struggle, that's the time when it's hardest for them to get the financing. Right? So back to this. If I want to take my 5% G and make it 10% a year, how do I do it? What are my options? What are my options to get a 5% G to get to a 10% G? Given that formula, what could I do? Yes? You can make your reinvestment rate 100%. 100% reinvestment times 10% ROI is a 10% G. Now, not to slash all the dividends. As a publicly traded company, that might be hard to do. But that's one way to do it. Is I could just not reinvest, not pay out, put all of it into reinvestment. What if I don't want to slash the dividend? What's another way to increase my G? Yeah.
You could decrease your return on investment to 5%.
Actually, I have to increase it to 20. Because a 5% ROI times a 50% reinvestment rate will be a 2.5% G. So if I want to make it 10%, I need a 20% return on investment times a 50% reinvestment rate to get a 10% G. So you have the right idea about changing the ROI, but that's the point. All the projects overnight would have to double their profits. Okay? That's not easy. Can't just really wave my hand and have that happen in most businesses, but that's the point. Those are my drivers. That's my ability to actually reinvest. Make sense? Questions about this? So just as a quick example here, let's go to everybody's favorite monopoly, Google. And I'm going to go to EEO. Actually, before I go to EEO, I'm going to go to RV. And when I'm going to look up for Google, custom, in our little template, is I want you to look at Alphabet, which is row 101. That's Google. I want you to look at Alphabet's ROIC. 23.91% last year. All right. Let's assume since they're a monopoly, that's going to keep going forward. All right. How much does Google pay out in dividends? Everybody know? 0. How much do they buy back in stock? They're not. So basically, and you can actually see on here, DPS is dividends per share. They're not expected to pay any dividends. They don't buy back out their stock. So basically, what's their payout rate? 0. They're not paying anything out. Okay? So they have no payout. What's their reinvestment rate? 100%. 100% times what's their ROIC? How fast can they grow? They can grow their ROIC. What was their ROIC? 23, 24%. So basically, they can grow 23, 24% with the internally generated profits without need to borrow any money. This is a forecast for Google's growth rate through 2025. I'm going to switch this to percentages. How fast is Google growing per year? 15, 7, 12, 13. Does Google need to borrow money to grow? No, they do not. What's going to happen to all the cash they don't use to reinvest? If they're not paying it out, where's it go? It just sits in the bank, growing in their checking account year over year. They'll just accumulate more and more cash. That's what Wall Street is forecasting for Google today. And that's the point. That's why Google's not too worried about what happens to them, because unlike other firms, they don't have to go to the banks and beg to basically fund payroll. Right? Now they're trimming payroll, they're getting rid of people, but they're doing it because they don't think they need the people. They're not doing it because they're in some sort of financial distress. Questions? Make sense? Concept number 2, free cash flow. You are not worth the sum of your future profits. Because the problem with your future profits is you can't pay it out. Okay? Take a car. Right? Let's say you have a Chevy truck that when the world ended in 2003, you stuck in a garage for 20 years. Right? So if you watched The Last of Us last night at the end, they got in that truck and they drove away. Okay? But I'm telling you, if no maintenance was done on a car for 20 years, they wouldn't be going anywhere in that car. Right? There's no car in anything, even without the end of a world apocalypse. There's no car that's going to make it 10 years with no maintenance. Well, the same is true with a company. If we don't put money back into a company, it's going to fall apart, just like a car. Right? Computers are going to wear out. Equipment's going to wear out, needs maintenance. Right? We're going to need new machines, etc. Basically, we have to reinvest some of those profits, or the business is going to crumble. And if we want to grow, we're going to take some of the profits and reinvest to help grow. So the point is, we can't pay out the profits because we've got to reinvest some of those profits. So here's the point. That's free cash flow. Free cash flow is profit after reinvestment, right? And the problem is accountants don't give that to us. They only give us profits. They don't give us profits after reinvestment. So we had to create our own financial term, right? But that's the point. Profit after reinvestment is what you can pay out. And that is called free cash flow. So the values of companies are not the net incomes. The value of the companies are the free cash flows. It's the profit after the reinvestment. The concept is easy. The practical part is hard because when we actually have to calculate free cash flow and we have to take these accounting accrual statements and turn them into cash statements to calculate profit and reinvestment, that's the hard part. The good news for you is you're going to learn how to do this in the second part of this course, all right? But it takes work, all right? But nonetheless, this is what's more important to the value of companies, all right? Now, here's the final and looks simple but very important slide. So, given everything I've been talking about, two hypothetical companies, A and B, these two companies start out with identical profits, $100 million a year of no plat each. Both companies are expected to grow at 5% per year, ... forever. So, same profit, same growth in profit, same risk. Both have the same cost of capital. Given everything we talked about, would these two companies be worth the same, or would one of these two companies be more valuable, and if so, who? Given the data on this slide, who's more valuable, A or B, and why? Yes?
Company B is more valuable because it has like a greater free cash flow since they're investing less money.
Yeah, it's pretty simple. We just said free cash flow is key to value. B has more cash flow than A. B is going to be worth more than A. All things being equal. Pretty straightforward. Everybody follow? But what's more important is why. Why does B generate more free cash flow than A? The second part of her answer was telling. What she said was, and I'll use a little laser pointer here, A invests more of its profits than B to make those profits. So since B doesn't have to spend as much to make the same profits as A, that's why they're generating more free cash flow. The reason they don't have to spend as much as A to generate those profits is because B is better at what it does. Makes a 20% ROI. A makes a 10% ROI. So this simple illustration proves to you mathematically that if you have a higher ROIC, all things being equal, you will generate more free cash flow and you will be more valuable. Because that's the point. ROIC is the shortcut for free cash flow. And that is the secret to McKinsey's approach. Free cash flow, as you're going to find out, is hard. It's hard to calculate, and for most people, hard to understand because they don't know any more than accounting. They barely know accounting, right? ROIC is easy. They're the same thing. It's rearranged math. But that's the point. If you have a higher ROIC, you generate more free cash flow. 20 cents per dollar of reinvestment or reinvestment is worth more than 10 cents per dollar of reinvestment. That's all we're saying here. Okay? Now here's the point. Why? Because either I'm going to spend less to make the same amount of profits, which was this example, or let's say B invested 50. Well, if B invests 50, not 25, at 20% ROI, it's going to have 110 in profit. So in either case, it's going to have more profits for the same investment, or it's going to have less investments for the same profit. Both will result in more free cash flow and therefore more value. Okay? And so that's what I want you to understand. At the same level of growth, higher ROIC equals higher value. Yes?
Why in company B is free cash flow 75?
Because it's profit of 100 minus 25 of reinvestment is 75 left of free cash flow.
Is that just like the gain?
I'm sorry?
Is that the gain?
I wouldn't call it the gain. I would just say it was the amount generated. So they generated 75 million of free cash flow. 105 minus 26 is 79 million of free cash flow generated per period number. Okay? But that's the point. they're generating more cash left, more free cash flow after investment today, which is generating 50 and 53, they're generating 75 and 79. So unless they're cutting corners here, so that's the important point of sustainability. Like if it's just a fraud and I just have like, a couple of pieces of paint on my thing and I don't do any back office things and I just slash all the maintenance and my facility's gonna start falling apart and I can't maintain that ROIC, well, that's not a real 20% ROIC. That's the sustainability aspect. Like we want to invest in companies that make 20% because they're good at what they do. We don't want to invest in companies that make 20% because they fired all the people, they cut all the investment, they slashed all the R&D, and in 3 years they're not going to be around. And it makes it look like they're all doing well, but they're really not. That's what we have to suss out. Okay? Now, final point for today, continuing value. The difference between a project and companies is companies are assumed to last forever. Projects end. Now, we don't know if companies are really going to last forever, but we assume that they will. So to value a cash flow that lasts forever, we use what's called a perpetuity. If that cash flow grows at a constant rate, it's called a growing perpetuity. So the formula for a growing perpetuity is at the bottom of the screen. Cash flow divided by R minus G. Okay? And that is the formula that you were taught to use in finance to value companies long term. This formula has two inherent problems. Problem number one, we are taking the entire future of a company and boiling it down to three numbers. All right? In a way, it's just a broadsword. It's very simplistic. It's brute force, but it's what we do. Problem number two, the formula for this assumes that the IRR on future cash flows equals the IRR on historical cash flows. Translation, whatever return on investment you make now, you make forever. So if I take a company like Marvell, which was losing 1% last year in the semiconductor business, and I apply this formula, they're going to lose 1% forever in this formula. They'll never improve, and I will likely undervalue that company. If I take this formula and I apply it to Apple, which last year made 45% ROIC, they're going to make 45% forever. And even Apple is not going to do that forever. They're eventually going to start to come back to earth. And when they do, this formula is not going to see that because it's going to assume they make 45% forever. It's going to overvalue them. So again, the problem with the formula that we are trained, that we all use in the real world, is it exaggerates the current performance into perpetuity. So McKinsey said, we're going to try and make this a little better. Not perfect, but a little bit better. So what they did is they created what they call the KVD equation, key value driver equation on the right here, which is just a rearranged growing perpetuity. And they made two substitutions to do this. One, cash flow is free cash flow, which is profit after reinvestment. So profit times 1 minus the investment rate. Sustainable growth is the investment rate times the ROIC. Therefore, investment rate is growth over ROIC. This formula is a growing perpetuity. But here's the difference. In this version of the growing perpetuity, that ROIC is incremental. I can have a different ROIC for the future than the past. And that's important. Because what I can do is I can put in an ROIC that is more representative of the future. Now, it's one number for the entire future of a company, but nonetheless, I can make it different than the current situation. Okay? That's the improvement. And that's the formula we are going to be using this semester. So let's put this formula to work. So on this slide, I asked you who's going to be more valuable, A or B. And I said, this is the formula on the right here that we're going to use. So what I'm going to do in Excel is I'm just going to put the data in from that slide, A and B, and then I'm going to use the formula to see if we were right that B would be more valuable. Answer that question. Oh, keyboard sucks. All right. So 4 parts of that formula. I'm going to add the word expected because it's the future profits, growth, expected ROIC, so it's your future ROIC, and the WACC. Those are the 4 parts of the formula. And if I solve for it, I'll get the value of the company. So here's the data from that PowerPoint slide. Both companies start with 100 million of profit. Both companies are expected to grow that profit at 5% per year. Company A has a 10% ROIC, company B 20, and both companies have 10% cost of capitals. So let's do the math. Using the key value driver equation equals profit times 1 minus growth divided by ROIC. Take all of this divided by WACC minus the growth. Company A is worth $1 billion. Company B is worth $1.5 billion. So I'm just quantifying what we intuitively said earlier. Now in the real world, there's something called a multiple, price to earnings multiple, PE. What is the price to earnings multiple that company A would trade at? What's their PE? 10. Their price is $1 billion. Their earnings are 100 million. They would trade at 10 times earnings. Company B, their price is $1.5 billion. Their earnings are 100. They would trade at a PE of 15. So one of the things you should quickly realize is that multiples are very much related to cash flow valuation. It's just rearranged math. So ROIC is a proxy for free cash flow. Multiples are the shortcut for free cash flow valuation. They have to be based on the same thing. It's just rearranged math. Matter of fact, multiples are the key value driver equation. Why does a company trade at a higher multiple? Multiples are an expression of growth and spread. That's all they are. So if I take a company like Google, which has a 15% growth rate and a high early 20s ROIC, they're going to trade at a much higher earnings multiple than a company like Ford, which has single-digit ROIC and low single-digit growth rates. Right? And it doesn't make one company better or worse. It just means they're in different stages of their life cycle and the performance of their industry. But that's the point. It's related to how much cash flow they will generate. Because Google, with their high ROIC, high growth, is going to generate a huge amount of cash. And Ford, with the miserable state of the auto industry today, with huge investments for electronic vehicles, is going to put in huge reinvestments with low rates of return. They're going to struggle with cash. And therefore, I wouldn't want to pay a huge multiple on that company until they can demonstrate they can make money, like Google. And so that's the point. That's what we're going to see starting to play out here in the real world. Questions, comments about any of this? All right, practical application of this on Wednesday. We're going to then bleed into EIC, which will be homework 2 due next Monday. For Wednesday, make sure you turn in homework 1, which is your screenshot. And again, you might want to catch up in the book. See everybody on Wednesday.